Welcome to Mayor Brown's Global Financial Markets Podcast. Each 30-minute episode is designed to help listeners better understand the legal issues that impact their business given the ongoing uncertainties in the financial markets worldwide. Speakers from across Mayor Brown's practices and offices provide their timely insights on a wide range of topics, including finance, financial services, and insurance regulatory developments, securitizations, and litigation in the United States, the United Kingdom, Europe, and Asia. We hope you enjoy the program.
Hello, listeners. Our topic today is the FDIC's new record-keeping proposal. My name is Matt Bizance, and I'm a partner in Mayor Brown's Financial Services Group in our DC office. Joining today is my colleague, also in the Financial Services Group, Kelly Truesdale. With that said, let's begin. Last month, the FDIC proposed requirements for the way in which banks keep records of certain deposit accounts. This is important because the FDIC insures all bank deposits, and this insurance is provided to a depositor on a depositor-by-depositor basis. FDIC-insured deposits are paid only in the event of a bank failure, meaning they don't cover other problems that a bank or an intermediary may undergo. But for many customers, they are a key attribute in selecting where they will place their deposits or how they will keep their money. Now, many depositors do not hold their money directly with a bank. They may hold it through, or a third party may hold it on their behalf. This is commonly referred to as a pass-through basis or a for the benefit of basis. And so the account at the bank is actually labeled in the name of Company A or Company Y, but really the money in the account belongs to a depositor. And in many cases, the money may be commingled in the account with that of other depositors. So it might be something to the effect of the account is for the customers of Company X or on behalf of the customers of Company X. This is not an issue, but this creates a complexity in deposit insurance because the insurance is provided on a depositor-by-depositor basis. And if the account title or the account is being used to hold the money of multiple depositors, well, how is the FDIC supposed to know how much each depositor is entitled to were the bank to fail? Historically, the FDIC has allowed banks to rely in large part on the account title and on the third party in whose name the account is held or who is maintaining the records on behalf of the depositors. And so the FDIC has said that in order to qualify for pass-through deposit insurance for the underlying depositors, the relationship must be disclosed in some way on the bank's records so that the FDIC knows when they show up on Friday and looks at the account title that it is for the Matt for the benefit of Kelly, and that there is clearly a relationship of a custodial relationship of some type. And then they also must be able to ascertain the details of the depositor's relationship based on records maintained either by the bank or by the intermediary. So going back to our Company X example, if the account title says Company X on behalf of customers, that would put the FDIC on notice that, there are custodial relationships at play here. We need to find out the details of each of the customers. And if the bank, for one reason or another, as is commonly the case, does not keep a record of those underlying depositors, the FDIC would go to Company X and say, we need your records of the money in this account, which depositors does it belong to, because each of those depositors is entitled to $250,000 of deposit insurance, and if we want to make sure that everyone is paid fairly. Now, this works in many smaller settings. That the traditional one I always like to think of, because I'm a lawyer, is the interest on lawyers' trust accounts. That when a lawyer has an account at a bank and it is money held for clients for different things like retainers, settlements, escrows, and that kind of thing, it titled the lawyer's trust account. And the title of it clearly conveys that the money in the account conveys to the lawyer's clients. And if you were to go to the lawyer's own office, you should find a record of how the money in the account is allocated client by client. And given that we're all only human, if you are an individual lawyer with an IOLTA account, you should be able to, the FDIC should be able to readily untangle from your even paper ledger how the money is allocated in your IOTA account. This structure breaks down in the modern era where intermediaries may hold funds on behalf of thousands or millions of customers. And also, unlike a lawyer's trust account where the escrow is only done in one transaction before closing, or the settlement payment is made in one payment at the conclusion of a trial, many money transmitters and other intermediaries make payments on a daily basis for their customers. And so there may be thousands of payments coming in and out of the pass-through account. And also there may even be on-us style transactions between a money transmitter's customers. So no money is actually leaving the account, but the amount in the account that belongs to Matt now belongs to Kelly because Matt has moved the money over to Kelly. This complexity still, in theory, works, but the FDIC, particularly since the 2008 crisis, recognized that this could complicate resolutions. And so, for particularly large banks, those with over $2 billion in assets, and at least 250,000 deposit accounts, or all those over 20 billion in assets, and also certain banks with more than 2 million deposit accounts, they are subject to enhanced record keeping requirements with respect to deposit accounts. This still, in many cases, does not require the bank to know the name or the amount owed to every underlying borrower or every underlying depositor, but it does put in place testing and other procedures so that the FDIC would have an easier time unpacking the pass-through account and allocating the money out to each actual deposit. As indicated by the topic of this, last month the FDIC proposed a sweeping change to the way in which these records must be kept for all banks, not just those of a certain large size. And so for any account where there is an intermediary, and Kelly's going to talk about what that imprecise term I'm using means in a minute, but this would radically change the way in which the FDIC looks at resolutions by relying more on an ongoing basis to true up these account ownership interests instead of looking at the end after the bank has failed to go to the intermediary and allocate out the deposit accounts. But I've talked enough here about the theory and history. Kelly, can you tell us more about the proposal?
Sure. Thanks, Matt. So as Matt mentioned, last month, the FDIC proposed fairly extensive new record-keeping changes for certain types of accounts that are frequently used by money transmitters, kind of other participants in bank fintech partnership arrangements to provide kind of these transaction-based services, wherein a customer may be making daily payments either into or out of, or even between customers within the same account. And so the FDIC recognized that these types of accounts present unique challenges, both on an ongoing basis and in the potential resolution situation. Specifically, the proposal applies to what the FDIC terms custodial deposit accounts with transactional features. And it's the transactional features here, which is really the defining characteristic of the account. And so these accounts are accounts that are established for the benefit of owners. So, Matt's company X is customer's example. These accounts hold commingled depositors of multiple owners. So it can't just be an account that's held, say, in Matt's name for the benefit of Kelly. It has to be an account that's in Matt's name for the benefit of some defined subset of people. And finally, the beneficial owners must be able to authorize or direct transfers through the third-party account holder to a party other than the account holder or the beneficial owner itself. And the example that the FDIC gives is to make purchases or pay bills. And the idea is these are accounts that are enabled for third-party transfers. They may be accounts that are connected to debit cards or that allow person-to-person payments, or otherwise have some functionality that on a day-to-day basis transactions can be conducted that will result in money moving in, out, or within the account with respect to different owners of the funds. And as Matt mentioned, these types of transactions introduce a number of wrinkles. You both have the scale and velocity of money that's moving in and out of the account. You have kind of the on-us transactions of money moving between beneficial owners while not necessarily leaving the account. And you also have the consideration where, depending on the nature of the payments, there may be transactions that will be initiated on one day and settle on a different day. For example, ACH transactions or credit card settlements where the beneficial owners swiping a card or initiating a transaction that won't actually be reflected on the records of that account until some subsequent day. So the FDIC excludes from the custodial account, the custodial deposit account with transactional features definition, a few types of accounts that have transactional features in some respect, but are typically just limited activity or covered by other types of regulations. And so some of these examples are accounts that will only trust deposits, certain government deposit accounts, accounts established by broker dealers and investment advisors. Matt's example of the IOLTA account is also one that, based on its limited transactional activity, wouldn't be something that's covered. There are a number of other exceptions, benefit plans and real estate accounts, et cetera, that have similar functionality, but because of the nature of the account or the nature of the transactional activity that's conducted through it, the FDIC concluded wouldn't raise the types of concerns that the rule was intended to address. So specifically for accounts that are subject to the rule, and as Matt noted, there's no de minimis in terms of the amount of funds in the account, the volume of transactions, et cetera. So any account that has the three characteristics that I mentioned, regardless if the bank only has one of those accounts or if that account only has a small amount of money in it, would be subject to these new rules. The new rules would require that the bank maintain records identifying the beneficial owners of the account. And so, contrary to the example that Matt gave earlier about how the account can record the fact that the funds are held for the benefit of company X and indicate where to go find those records at company X. Under the proposal, the bank would actually have responsibility for maintaining the records of the beneficial owners of the account. And as we'll discuss in a moment, that doesn't necessarily mean that the bank has to, itself have a giant Excel spreadsheet of where all the funds are allocated at any given second. And some of that can be offloaded to a third-party software provider, vendor, et cetera. But the general rule is the bank, unlike in the current construct, is much more responsible for either having or being able to have access to the records of who has a beneficial ownership interest and what that interest is in the account at any given time. Under the proposal, the records would be required to be stored in an electronic file format that's prescribed by the FDIC. It's a very specific format that draws upon and looks pretty similar to the file format for the enhanced record keeping that I mentioned for certain financial institutions that have more than 2 million accounts. And this format is required regardless of whether or not the bank is maintaining the records or it's relying on a third party to maintain the records on the bank's behalf. In addition to the kind of general record keeping requirement, the proposal requires banks to maintain internal controls. This is accurate deposit account balances, including the respective beneficial ownership interest associated with the custodial account, conducting reconciliations of these ownership records no less frequently than daily, which is a notable development. And they would also need to consider, the possibility that there may be multiple layers of third-party ownership or third-party ledgering of these accounts. And make sure that the internal controls considered those risks and allowed the bank to still determine the ultimate beneficial owners of these accounts. So as mentioned a moment ago, banks would still be able to use third parties. So to the extent company X is maintaining the records, the bank could still rely on company X to maintain records. However, there must be additional requirements, and these requirements are on the bank and are driven by the bank's responsibility and ultimate responsibility for knowing the beneficial owners and their respective allocations within the account. And probably the most notable of these requirements is the bank itself would have to have what the FDIC terms as direct, continuous, and unrestricted access to the records maintained by the third party. And that access must be in the specific file format that the FDIC provided. So the idea is that the FDIC would be able to get the information that it's looking for in the format that it needs, regardless of whether that information is maintained by the bank or maintained by a third party on behalf of the bank. The bank is just required to make sure that it has the ability to access that information on a continuous basis, including in the event of business interruption or insolvency of the actual third party. And there have been a number of ways that the FDIC proposed that can be done, things like providing the information on a periodic basis, third-party access, maintaining licenses to networks that provide that information, et cetera. In order to facilitate these types of arrangements, the proposal would establish some fairly specific requirements for the contracts between the bank and the third party that maintains its records. A couple of these are to very clearly define the roles and responsibilities for record keeping. One of the more notable ones is to assign the bank rights to the third party that are necessary to access that data to the extent that data is held by by essentially a fourth party in this scenario. And the idea there being if the third party that's maintaining records on behalf of the bank, suffered a significant business interruption and wasn't able to deliver the information, the bank itself could go to, say, a hosting provider or some other fourth party that was maintaining those records, and then ask them for a copy. And then additional requirements provide that the third party must undergo periodic validations, and this has to be by a person that's independent of the third party. It can be the bank itself, or it can be a separate validating party to ensure that the third party itself is actually maintaining the accurate records that the bank needs, and that the reconciliations that are performed by the third party are performed consistent with the record keeping requirements. And then the bank must be provided with those results, because ultimately the bank is responsible for maintaining the accurate records here. And then one final point on the third party's ability to maintain the records is the bank can only rely on records maintained by the third party if the bank itself implements internal controls to accurately determine the ownership of the underlying accounts, and the bank itself conduct reconciliations against those reports no less frequently than daily. And then finally, I think the last thing that's worth noting in the proposal is that it also imposes a number of additional oversight requirements on banks. So one of the most notable, and this is something that's similar in other types of the enhanced record keeping requirements, is the proposal requires an annual certification from the CEO, the COO, or the highest ranking official at the bank that the bank has implemented and tested these record keeping requirements in the last year. And that certification has to be submitted to the FDIC and to the bank's primary federal regulator. The bank's required to continue to provide that certification. And if the FDIC deems it necessary, that certification may be required more often than annually. I think that ultimately the takeaway is that the proposal imposes on the bank itself a number of new requirements that the bank can push down to third parties that maintain records on behalf of the bank under certain circumstances, but ultimately shifts the responsibility for maintaining records of who owns funds held in these custodial deposit accounts with transactional features back to the bank from where it had traditionally been largely left to the third party.
Thank you, Kelly. That was very informative and a little scary when I think about trying to, I no longer do. When I was in college trying to balance my checkbook. I want to thank our audience for listening. Without you, we wouldn't have a reason to do these programs. Listeners, if you have any questions about today's podcast or anything related to global financial markets, please email us at gfm@mayorbrown.com. Thanks for listening and have a great day.
We hope you enjoyed this program. You can subscribe on all major podcasting platforms. To learn about other Mayor Brown audio programming, visit mayorbrown.com/podcasts. Thanks for listening.